I believe we're in a new super cycle for gold. It's had a pause and we're having a run up as we get closer to a recession, to a financial crisis. People are moving into gold, very similar to what we saw over here. We had a new super cycle for gold. It consolidated for a couple of years, and we saw money moving into gold just before we got into a recession and a financial crisis, which was the 2008 pullback. Gold pulled back 32% or 34%, and then it took off. So I believe gold has this little bit of upside back to 2650, 2750. And then we're probably going to hit this recession, some financial crisis, whatever blows up. And then we're probably going to see gold have some type of pullback. After that pullback, which I'm kind of hoping is next year, is when gold starts this next multi-year run up.
Gold's price peaked above $2,500 per ounce and is currently at $2,445 per ounce. This rise has been driven by global tensions and economic instability, underscoring gold's enduring appeal as a safe haven asset. As the US dollar and bond yields give up some of their recent gains during Tuesday's European session, gold maintains its key ground at $2,400. Investors seek fresh cues to clarify whether the United States will enter a recession. Market participants also await signals about the Federal Reserve's plans regarding interest rate reductions this year. ChrisVermeulen, founder and chief market strategist of thetechnicaltraders.com, offers insight into the current market sentiment. He predicts a short-term bullish trend for gold, with prices potentially reaching $2,650 to $2,750 per ounce, representing a 10 to 11% upside. However, Vermeulen anticipates a pullback during an upcoming recession or financial crisis, possibly next year. Meanwhile, silver faced significant pressure early Monday, dropping to the crucial $26.50 level, which has been a pivotal point multiple times. The metal appears to be slicing through the 200-day exponential moving average. According to Vermeulen, silver is more volatile than gold and remains far from its all-time highs. Despite this, he holds a long-term bullish outlook for silver, expecting it to outperform gold percentage-wise. Data from FX Empire indicates that a small bounce might be expected with such a sharp drop at the start of the day. However, confidence in the bounce is uncertain. There is a strong likelihood of breaking through the support area, suggesting caution for potential buyers. Please tune in for our exploration of ChrisVermeulen's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
I still really like gold. I think gold's going to 2650, 2750, which is more or less, up to here or somewhere up to here. So there's still some good upside potential percentage-wise from where it closed. There's still another 10%, 11% to the upside, which is really just Fibonacci measured move. You have the run up, you got the pullback, and then the second half of that move. So I'm still bullish on gold when we look at it over the next several months. Now, the monthly chart, which you and I looked at last time we spoke, the monthly chart to me is when we step back as a long-term investor, where is gold going to be 5-10 years from now? I believe we're in a new super cycle for gold. It's had a pause and we're having a run up as we get closer to a recession, to a financial crisis. People are moving into gold, very similar to what we saw over here. We had a new super cycle for gold. It consolidated for a couple of years, and we saw money moving into gold just before we got into a recession and a financial crisis, which was the 2008 pullback. Gold pulled back 32% or 34%, and then it took off. So I believe gold has this little bit of upside back to 2650, 2750, and then we're probably going to hit this recession, some financial crisis, whatever blows up, and then we're probably going to see gold have some type of pullback. And then after that pullback, which I'm kind of hoping is next year, is when gold starts this next multi-year run up. So short term, I'm bullish on gold. Long term, I don't think there's a huge rush to get in because I think it's going to be back at this pricing or a little bit lower, maybe a year from now. But that will be the last opportunity to pick up physical or miners. That's when miners should come to life, is somewhere over here after we've had the financial reset. They should come screaming back to life. So depending on who you are, the type of investor you are, I like physical metals. I've got physical metals. I don't have any gold miners at this point, just because I think gold miners are going to be amazing, 6, 8, 12 months from now. That's when they'll have an opportunity that could last years.
So you're bullish on gold. What about silver?
Yeah, silver is much more volatile. Obviously, silver is nowhere near the highs up or up around $49. This is the weekly chart. It's nowhere near the highs from just even a few weeks ago. It's actually still down 13%. Silver, I'm bullish on silver. Silver percentage wise, I think is going to do exceptionally well. It'll outperform gold in the long run, but gold is the global safe haven play. It's low volatility. People from everywhere buy it. It's kind of one of their first plays. Like, what do I do if I don't want bonds or stocks? They say, I'll get some gold. More aggressive traders move into silver. They move into miners. They have more potential, but they're a higher risk. If you're not going to make a ton of money, if there's not huge opportunity, it's probably a consistent high probability trade. Silver and miners are volatile. People get into them and they suffer forever until there's a super cycle, which we're still probably 6, 8, 12 months away from the next major leg up. Whereas gold is hitting new all-time highs, as you mentioned, James, and it's just consistent. If you want a low risk, high probability trade, you're not going to like make a fortune, consistently make money. Gold is that. That's why I love physical gold. I like charting gold, and silver will play catch up later, but you got to go through that roller coaster ride because it's a risky one, and you need the stars to align perfectly for gold for silver and miners to like skyrocket.
U.S. stocks are tumbling on worries about a slowdown in the U.S. economy, and it appears that even the prospect of lower interest rates is not helping investor sentiment. ASX-listed stocks are also feeling the fallout of increased global market volatility today, despite recently reaching record highs. After a massive run-up through mid-July, U.S. stocks appear to be under immense selling pressure. Media reports are filled with predictions of impending doom, and the usual bearish commentators view the recent decline as vindication of their "the sky is about to fall" narrative. Before we get too concerned, let's put things into perspective. Using the S&P 500 as a guide, the U.S. stock market peaked on July 16th at 5,669.7, up 25.8% on a 12-month rolling basis, and a whopping 45.4% from its October 2023 low. As of its close on Friday, August 2nd, it is down 10% from that all-time high of 5,669.7. ChrisVermeulen offers insight into the current market conditions. He notes that internal indicators, cycles, money flows, and momentum suggest we are on the cusp of a bear market phase. Whether it will be a minor bear market like 2022 or a major financial reset akin to 2000 or 2008 remains to be seen. Vermeulen warns that the potential downside could be 30 to 60%. Let's get back to the interview.
I've talked to a lot of advisors. They're all saying, get into bonds, get into bonds. Unfortunately, most of their clients are already in bonds and they've been holding them from, they're down 40% on them. But they're trying to tell people to shuffle in, which is a little bit concerning, but I'm not a fan when everybody's saying get into bonds. But if rates are going down, we should see bonds go up, and they are starting to firm up. And, we saw a lot of panic on Friday in the stock market with the VIX skyrocketing, stocks crashing, and we saw people move into bonds as I think what also helped fuel it's a defensive play. People are naturally want to move into bonds, even though they've been beat up on them. So it definitely had a big move. We saw TLT move 3%, which is huge for TLT. The other interesting play is actually the utility space. The utility space is giving some pretty interesting divergence, where if I was to compare the SP 500 in here, and if we just look at those two charts together, we're in this point where we saw this just before COVID, the COVID crash, which is we see utilities do exceptionally well. So the stock market topped out here. It's down about 5%, the SP 500. From that same time window, we've seen utilities, they have pushed up about 8%, but they're up about 6%. This is a huge divergence. The fact that the stock market is crashing and huge panic and people are moving into utilities, we saw almost this same type of thing happen just before the stock market fell off a cliff for COVID. And we see this over and over again, not to this extreme, but over the last several years, every time utilities perform really well, the indexes pull back a bit. The indexes usually will fall even more, and then utilities will fall with it. Right now, this is just a defensive play. When the stock market does potentially bounce over the next week or so, and it starts another down, if that's what it's going to do, utilities will get wiped out too. It's just a short-term play of people moving in. So there's this divergence here is a big warning flag that I think we're about to see big pullback in the market. The internals, the weekly chart, when I look at our weekly trend chart of the markets, we want to know when we are in a bullish environment. We also want to know when we're in a bearish environment. We are still in a bullish environment right now, but everything this week, based on the closing bar, because this is the weekly chart, is telling us we are like kind of like right here, or we are like right here. We're very, very close. Everything behind the scenes, cycles, money flows, momentum, all of that stuff is telling us we are like right on the cusp of starting another bear market phase. And the question is it just a small bear market like 2022, or is it, a stage for massive financial reset like 2000 and 2008, where we see the stock market potentially fall 30, 50, 60% or more? That's where we have to stand. But behind the scenes, this market has broken down on a weekly standpoint based on a big trend. It hasn't given us an exit signal yet for long-term investment capital, but we are darn close, a week or three away from potentially closing all long-term positions in equities, because we're going to go into a potentially year or two pullback, or a lot bigger than that.
Given the potential downside and uncertainty in the market, how are you preparing your investment strategy for the possibility of a significant bear market phase? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.